it's pretty affordable compared to California, for instance. And so, yeah, you're laughing. I mean, I live here and I love it, but I don't buy anything here. It's mainly because of rent control and compressed, cap rates.
Hello, everybody. This is Gino Barbaro, host of the Wheelbarrow Profits podcast, and today I'm excited to welcome a very special guest to the show. Today's guest is Ellie Perlman. Ellie is a real estate investor, attorney, entrepreneur, and holds an MBA from MIT. She's definitely a smarter person on the call today, everybody. So, like many of us, she's had financial struggles early in life, but that lit an internal fire in her to create a legacy and leave her mark on this world. So, without further ado, Ellie, welcome to the show.
Hey, I'm really excited to be here today. Thank you so much for having me.
It's my pleasure. I mean, how did you get into real estate? I mean, you're an investor, attorney, entrepreneur, you got an MIT. I mean, why real estate?
Well, I've always, I've looked around early in my career actually as a lawyer, and I've noticed that the people who were the wealthiest, the most successful, were in some shape or form were involved in real estate. And that understanding actually drew me to real estate. And that's why when I was an attorney, I was representing developers and investors. And so I was always around real estate in other capacities. And then I transitioned to property management. And all that was back in Israel where I am from. And then I decided to move to the States. So I went to, got my MBA degree. I wanted to get a little bit more of, hardcore knowledge about financing, marketing, and how to build companies. And then started investing in real estate. And that's what I do today.
When did you move from Israel to here?
That was March of 2014.
I've got a couple questions about being a lawyer and about the move and investing from overseas and the different markets. But from your perception, what do you think lawyers think of real estate agents? Because you're a lawyer, you're on that side of the table. Do they think we're crazy, or what do they think? Because I know lawyers love to kill deals. I mean, lawyers are always looking at a deal and saying what can go wrong. So, from your perspective, what do lawyers think about real estate investors?
That investors are taking a huge risk. They just don't get it, because it's exactly like you mentioned. We think that, and I still think every time I see a deal, I think, what are all the things that can go wrong, and how am I protecting myself and my investors from it? Because that's how lawyers are trained. We're trained to hate risk. We're trained to try and find all the loopholes and cover them to the best of our, ability. And so lawyers they're pretty much see investors not as crazy people, but as people who are taking a lot of unnecessary quote unquote risk, because it's hard for them. It's not everyone. I definitely have lawyers that are my investors, but the vast majority, anything that is not certain is not comfortable.
So what was hard for you making that transition from being a lawyer to going into the investing world?
I don't think that was very challenging for me, because I am risk averse compared to the average investor, but I'm more of a risk taker compared to many people actually that I know. So I think that part of my personality that likes challenges, that likes to, is not comfortable when I'm in a comfort zone, actually help pushing me out of my comfort zone, from my cushy position as a lawyer, to try and do something more exciting, something great, to actually build something. So when you see a property, and that's what I love about real estate, you see a building, you can feel it, you can touch it, you can transform the experience for tenants, you can increase the cash flow. All these things are super exciting for me.
So we're talking about risk. What is risk to you in real estate investments? It might be something different for me than for you. What do you classify as risk?
So for me, risk is, when it comes to financing, for instance, is taking loans where you're not sure how much your payments are going to be every month. That's a risk I don't like to take. And because there's an easy way to mitigate the risk, you just take a loan with a fixed, interest rate, and you know exactly how much you're paid. For instance, risk is to take a building that is half empty, which I personally don't do, because I still like to avoid the risk of not being able to pay debt, and I like to buy stabilized assets, so assets that are above 90%, occupancy. So
Mm-hmm.
for me, these are the two most prominent risks that I'm trying to avoid at all costs.
Mm-hmm. When you came here in 2014, what was your first deal? Was it a syndication, by yourself, partnership? What did that look like?
Yeah, it was actually a partnership, and the deal was a syndicated deal. I actually went through the whole process of thinking, once I realized that I wanted to be in real estate. I know a lot of people are going through that process. They think,
Mm-hmm.
okay, what exactly do I want to do? And I started thinking, do I want to do fix and flips? And I started going to conferences, to meetups. I even drove for dollars, which is kind of trying to drive and find the ugliest house in the best neighborhood. And I realized that it's not really what I wanted to do, that it's really hard to scale, not impossible, but harder to scale. And then I said, okay, why don't I do buy and hold and maybe buy a house? And I started to look into buying single family homes, and quickly realized that based on where I want to be in terms of income and doors that I want to own, it's going to be extremely hard to buy
Mm-hmm.
all those homes. So if you think about it, if you buy, say, a 50 unit building, it can take 2, maybe 3 months to complete a transaction. Now try to buy 50 homes. Now, how
Mm-hmm.
much time that's going to take you? A
Mm-hmm.
lot of time, several years, and they're not in the same place. It's a bigger headache to try and manage all those 50 doors. And I realized that economies of scale is actually in buying a building. And
Mm-hmm.
this is where I started. And that's my first deal was actually a deal. I partnered with someone who was more experienced than me at the time. And basically we bought the property and we syndicated the deal. We raised capital from investors and we still own the property. So that was my first deal.
So, Ellie, walk us through the limiting beliefs you must have had because you come here from another country, right? You're new, you're getting into the space, you're looking at all these different asset classes. Fix and flip doesn't work, single family doesn't work, but where am I going to get the money for multifamily? What limiting beliefs did you have about multifamily before you actually jumped in? Or if you did you have any?
I think one of my limiting beliefs were that I really have to have a lot of money to invest in real estate. And that's
Mm,
kind of what stopped me from actually trying. And I didn't understand, how am I supposed to make money if the main source that I would like to make money with or through is real estate, but I don't have enough to buy, a building, maybe a
mhm,
house or two, but not a building.
mhm,
And it's a very limiting belief because, it's that's the whole syndication model was designed for it. So you put a little bit of your money if you have some, and it's okay if you don't have it, but then you bring investors money because they have money, they don't have the time to find the deal to manage it. You have the time, but you don't have the money to buy an entire building. So
mhm.
that's where, when basically, you can basically combine your time and investors' money. So that's one of the limiting beliefs that I've had. I see others struggling with the idea of wanting to start syndicating, but they don't have enough experience. And so, how do I get experience if I don't have my first deal? But I can't have my first deal unless I have experience. So
Mhm.
that's also a very, very limiting belief. There's a relatively easy fix, but it's not easy to implement, which is to find someone more experienced and find how you can add value to that person. Whether, maybe you know how to underwrite deals, maybe you know how to bring some capital, maybe you can find a deal. There's so many ways to get involved in real estate. Find that person you want to work with, find what they need and cater to that need, and get your foot in the door this way and start accumulating your, building your track record and your experience by partnering with someone who is more experienced and learn how to do it along the way.
I hope everyone heard what Ellie just said because it's truly important. Let's bookend what she just said that if you don't have the money, there are so many different ways to get into real estate. And I think what people don't know, they don't know, and they go up against it, and their beliefs just shut them out before they even start. So it's important to surround yourself with people who have done it before. I think that's really important. And it's important to expand your mind and to see what value you have. Obviously, if you don't have any value, then you can't do it. But we all have some kind of value. If you're in a market that has deals, drive around for those deals, talk to brokers, start talking to people who have properties, talk to property management companies. Maybe they're trying to sell their deals. And then you go out and start partnering with others. On that first syndication, Ellie, what pitfalls or what problems did you have, if you had any? Like, on the first one, what I was amazed with
Yeah.
syndication, they move so quickly. We've bought our first 1,000 units by ourselves. That's a different challenge. But then after our first syndication, I was like, wow, this ball moves really fast. What did you find in your first syndication?
Yeah, I think, the main challenge in my first indication was not streamlining the processes and
Hmm.
trying to tackle each, assignment and each item on my to-do list. So one of the main thing was that I didn't do well. And if anyone is, listening to me right now and trying to raise money, I think that will be very valuable. I tried to talk to each investor that was on my investors list and pitched the deal to them one by one, repeating the story, answering the
Hmm.
same questions over and over again. That I was really, exhausted by the end of the day. It was so inefficient. I spent so much time, and after I've done that, I raised the capital. But I'm always looking at the last deal, and I'm thinking, what did I do wrong and what did I do well, and trying to grow and and learn from that. And the process was so, for me, was so painful to raise the capital that I said, there's got to be a better way. And the way that I found was to basically use technology. And, I was using freeconferencecalls.com. You can use, Zoom. There are so many other platforms out there where I basically, and that's what I did on the next deal. I sent an email. I invited all my investors to listen to the live conference call. And of course, I sent them the deck earlier if they wanted to look at the deck before. And then I went over some important slides that I wanted to emphasize. I talked about the deal, and it did two great things. One, it cut my raising capital time and effort by more than half, because I had to repeat the story only
Hmm.
once, and then I sent the recording to everyone else. And that was the main thing. And so people who were on the call right after the call ended, I started receiving emails and text messages that with people, basically committing to the deal and saying, put me in for, 50,000, 200, whatever it was. Um, sorry, not 1,000. I do not raise $1,000, 50,000, 100,000 and above. But it worked like magic. And
Hmm.
the second greatest thing that it did, besides streamlining the process, it actually increased the amount of capital that I could raise, because it's very, very different when people see you and hear you talk about the deal than when you just send them the deck and hope that they'll scroll over and focus on the areas where you want them to focus on.
Hmm.
So I learned how to do the process faster, and I enjoyed doing it because it was a lot more fun not to repeat the story 50 times, but then over 100 people or 70 people listen to the conference call. And you can also track and see who opened the email, who listened to it. You can follow up with those who listen. Sometimes they listen to it a couple of times. So really taking technology and helping streamline, improving the process, and enjoy doing it along the way.
So before you got in that first deal, where was your education? Was it basically from getting the MBA, or like who taught you to underwrite these deals? Who taught you about the syndication process? Was it your partner who had more experience?
So actually it was a combination. When I was at MIT, I focused on real estate, and I took, real estate classes and underwriting classes. And then I also got a mentor. I realized that
Hmm.
there are two ways to do it. Either, read a book, listen to podcasts, or try on my own. And I didn't want to take the risk, being the risk averse that I am. I didn't want to take the risk, especially with investors' money. And I could have done it on my own, slower, with more mistakes,
Hmm.
costly for the most part. And the other path was pick a mentor that you like and do what they do, and find a way to build your business faster, because you don't need to figure out how to do it. You know how to do it. You have all the tools, all the knowledge. Now implement it and grow faster.
Hmm.
And I understood that I can't really protect myself from making mistakes in real estate. It's in, we're humans after all, but many mistakes I could have prevented, and they would probably cost more than the cost of that course. And I
Hmm.
saw it as an investment. And I found a mentor, and that's basically what I did. I learned from that guy how to raise money, how to underwrite deals, which is nice to complete. It's I've learned it at MIT, but then it was interesting to see other aspects of value add and how to underwrite deals from a different perspective, and that's how I learned.
I love that. There's a recurring theme, everybody, when we interview somebody who's super successful, it's always education times action equals results. You could take massive action, but if you're not educated on something, sooner or later, you're going to make a mistake. So that's really important. I want you to go back and just give a couple more tips on capital raising. I'm going to share something with the listeners about what resources they can use, but what other tips do you have for capital raising?
So I will start by, what I've said earlier about finding those tools, and they're usually free or don't cost a lot of money, to streamline the process to make it more effective. The other, big tip, and what I've learned, because I had a mentor, so I learned how to do it, is raise money before you have your first deal. And it's super important, because once you have a deal, you don't have time to start reaching out to people for the first time. And in addition, if this is something new that you're doing, it takes people time to process that you're a syndicator now, and you can't, most odds is that if you have a deal and you reach out to investor, usually it's someone that's how you start. The odds, it's going to be very challenging for that person to invest with you if that's the first time they hear about you syndicating the deal. And so what I did 6 to 7 months before I had the first deal, I actually created a list of investors, and I reached out to them, which were people that I thought either had interest in real estate or money to invest. And it was really good, because some of them were not interested in investing in real estate at all. Some of them didn't want to invest in syndication because they wanted to control the deal. And some of them didn't have money, and I thought that they had money. And by the time that I had the deal, two amazing things happened. One, I knew exactly who to reach out to because I've done the work before and I saved time. And second, I prepped my investors beforehand, because so by the time when I started talking to them, they said, "Oh, you're doing syndication now? We didn't know. We thought we were doing something else." So it took, I gave them the time to process that this is what I do now. And in addition, I educated them along the way, because many people, surprisingly, and it's not real surprisingly, it's surprising to me because I'm in this world, but many people don't know what a syndication is, and they need time to be educated. So when you have the deal, the clock is ticking. Once you sign the contract, you have 60 to 90 days to close. You don't have time to start educating investors and start figuring out who is a potential investor. You want to do the work beforehand. So by the time you have a deal, you get back to investors, you know who to talk to. They already know that you're doing this. They already know what a syndication is and how it works. And the only question remained is not, "Oh, I didn't know you're doing this. Tell me how you got into it," or "What is a syndication?" But it's, "Do I like the deal?" And that's the one question you want to focus on.
I love that. So let's recap that. Number one is the deal before the money. That's really important. Everyone's saying, I'm sorry, the money before the deal. Everyone's saying, I got to find a deal, then I'm going to find the money. No, you have to always be dialing for dollars. That's the most important thing. The next thing is to create what, Grant Cardone likes to call his power base. Try to sit down and take 10 or 15 minutes. And if your uncle, ask your uncle who he knows, or your aunt, or you'll be amazed, your siblings, whoever. Just start building that power base. The third one is really important. I love the education aspect of it, because start talking to people about their self-directed IRA also. They may not know that they can invest in an IRA. So that education, and you're positioning yourself as an authority, as a thought leader, and adding value to that. And the fourth one, I guess, is just tell everybody. Just tell everybody what you're doing. And it's important. What Ellie's talking about, it's a long game. It's not going to happen in 2-3 months. This is at least a 6-month process where you're working towards it. I always say, I'm the simple guy. I'm the farmer, like my dad. You're planting a seed and you've got to water the seed, right? And it takes a little bit of time. And it's not instant gratification where you buy a home and you flip it in 3 months. This is the long game. This is why there's wealth creation. This is why you have tax breaks. This is why you have a great life, because you're creating a business out of this. So it's that important. There's one thing I like to mention to the listeners also. When you're starting a syndication, you're starting to raise capital, think of it as you're a salesperson. So I'm creating this program with Jake and Gino that I call it the 3 elements of a pitch. The first book that I reference in is Oren Klaff's Pitch Anything. it's really important to learn how to start pitching a deal to somebody. I hate using that word, but it's more of an opportunity. And what you're trying to do is you're trying to learn how to actually send a message to somebody. The second book I'm going to be referencing is Robert Cialdini's Influence. There's weapons of influence out there, whether it's authority, proof, reciprocity, commitment, and consistency. All those things you can use in your pitch. And the third one is Kendra Hall. She wrote a book that's Stories That Stick. We have to create our stories. Ellie's got a great story coming from overseas, being an entrepreneur, leaving the lawyer world. And as she starts that off with her pitch, and now she says, I'm syndicating, you always want to create stories in your presentation and make yourself more attractive. Because if Ellie comes out and she says, I'm offering 6% for rate of return, 37-year hold, people shut down. But if she starts talking about real estate, what real estate can do for you, and take a look behind Ellie where you are, you got palm trees and you're talking about your story, I think people have to learn how to pitch their opportunity before just going out there and throwing out. So how do you start your presentation as far as trying to offer the opportunity to somebody?
So it's an interesting question because I've tried multiple, formats. I
Mm-hmm.
think the one that I like the most is why I'm excited about this opportunity.
Mm-hmm. Okay.
And I always invest in all my deals, and I make sure that investors know that. And I
Mm-hmm.
start with that and say, hey, I'm investing in this deal from my own money. My own money is being treated like everyone else's. So if you get 6, 7, 8% pref, that's exactly what I'm doing,
Mm-hmm.
what my money is making. And this is why I'm excited about the deal. And it's not so much structured because it's not always in my presentation, but it just, comes from the heart and just saying, hey, this is why I really like it.
Mm-hmm.
And then before, I dive into the business plan, the location, just a few highlights of what makes this deal unique and what really drove me to buy the deal and what's exciting about it.
Mm-hmm.
So that's how I start.
I like it. So I would even start further, everybody. If you're talking to a novice investor, the first thing you need to do is make them understand why multifamily. It's a basic human need. It's food, clothing, and apartments. Those are the three basic human needs. Let them understand why multifamily, right? Because as Oren Klaff says, you're pitching to their croc brain, which is their primitive brain, right? So you have to make them understand something a little bit different. Make them understand that it's a basic human need. Make them understand what's going on in the economy. Start talking about demographics. This is all stuff that you have to learn. Why millennials and baby boomers are renting. Why we're becoming, from a single family home nation to a renter nation. Just talk about all that stuff, and then once they're like, oh wow, I never thought of multifamily. Most people don't even know what multifamily is, let alone syndications. Then you warm them up. Then it's time to start offering the presentation. But this takes time. It doesn't happen overnight. It takes a little bit of time to do all that. Right now, what types of deals are you looking at? What types of markets are you focusing on this part of the cycle?
So I'm looking at markets in Georgia, Texas, and Florida. And I chose those markets because they have a very significant job growth, which in my opinion led to population growth.
Mm-hmm.
So there's, solid population growth, job growth. Rents are growing faster than I've seen, even though now it's a little bit, it's still growing, but on a slower pace.
Mm-hmm.
But those markets are solid because they have a lot to offer. The weather is good. There are more and more companies move there and offer jobs, and it's pretty affordable compared to California, for instance. And so, yeah, you're laughing. I mean, I live here and I love it, but I don't buy anything here. It's mainly because of rent control and compressed, cap rates. But those markets, I like them also because they're very landlord friendly. It doesn't take 9 months to evict someone. There's no rent control. Hopefully that's going to stay the same. And there's also the last part is what I like about it, especially at where we are right now in a cycle, is that those markets are very well balanced between cash flow and appreciation. And again, I'm a very conservative, and I like to buy properties that are cash flowing from day one, but also have appreciation. So that the value of the property is going to increase. I'll be able to sell it at a higher price than I bought it. And so I have my profits are partially from the cash flow and partially from the appreciation. Now, other markets have maybe stronger cash flow in the Midwest, for instance, but some of them are not very strong on the appreciation side. And then you have the core markets like San Francisco, LA, New York, that are very poor in cash flow, or many times even have, negative cash flow. their appreciation is very strong. But again, if you're in the wrong, at the wrong time in the cycle, there's not going to be any appreciation.
Mm-hmm. So there's a lot of stuff I just want to recap with that because this is important. The first one that Ellie mentions is job growth. That's really important. The next one she mentions are rents. Rents growing is really important. That's a function of population growth and job growth. The next one is weather. I'm in Florida. I moved from New York to Florida 3 years ago for that. Those three reasons right there. The next one is the affordability of the market. Everybody, I hope you're all writing this down. The affordability of the market. The next one is no rent control. I mean, that means a lot. We're selling time. If your apartment's empty for 3 months, it's just like an airplane that took off. Those 3 months, you're not getting that money back. So it's really important. And I think the next one is a great point. The markets down in the Southeast are not linear. They're more up and down. Linear is more in the Midwest where it just sits still. You buy something for 30 a door. 5 years later, it's worth 30 a door. There's no capital appreciation. I don't like those other markets in the blue states because to me, that's more speculation. When you're just buying just for capital appreciation, that's not, to me, truly is not investing. It's like buying a stock with no dividend. I mean, you can do that. There's nothing wrong with that if you know where it's going. But I think, like I at least mentioned, the cap rates are so compressed right now. There's really not much room for them to go. And with all of this affordable housing and the fact that she mentioned local laws, it's really important to know what's going on your local laws. So I love those markets also. So job growth, rents, weather, or affordable living, no rent control. I mean, that's a great list to focus on. As far as deals, when you first got into it, what was your take on not investing in your backyard? Was that one of your limiting beliefs also? Because it was for me when I first started. I'm like, how am I going to not invest in my backyard?
Oh no, I knew right away that it's not going to happen in California.
Uh-huh.
It's especially with multifamily. We don't have where I live in Santa Monica. We don't have 100 to 300 units that are in the 70s or 80s or 90s, value
Mm-hmm.
add, which is the type of deals that I'm purchasing. And I knew that I can find value elsewhere. And
Mm-hmm.
because I had a mentor and he guided me on how to research the market, how to find the best market, my starting point was I'm not going to be able to buy anything here. And I looked at the market here, but across the street from where I live, there was a small buildings in the 40s, 40s vintage, rent controlled, that was sold for $850,000 a door. And
A
let me
door.
tell you, a door. And it was built in the 40s and it was rent controlled. And I'm buying properties at 100, maybe $150,000 a door. And rents here are not 8 times higher than
Mm-hmm.
where I buy. So I don't mind how much the door costs me. What I care about is how much it produces, how much income it produces compared to how much it costs. And so
Mm-hmm.
I looked around and I realized pretty quickly it's not going to happen here. And you have to be comfortable with investing out of state. And I also, I have a mentoring program and I teach my students how to do it as well. You have to be comfortable with that. And again, look at the most successful people in the world. Look at the Stenzianos of the world and look at other investors. They're open to invest elsewhere. Just you have
Mm-hmm.
to open your mind and find the right investment for you, the right market for you. And I have teams in those markets that are very experienced and they're managing the asset for me.
Mm-hmm. I
So of
like that.
course, yeah, I
No, I
fly
was
out there every quarter, but
yeah.
yeah, it's a
I was just going to transition into the teams. How do you find those
yeah.
teams? I mean, like, let me ask you, what do you think your 2 or 3 most important team members are, other than your mentor, other than your coach, maybe other than your partner? I mean, for us, it's really it's the real estate broker, obviously first and foremost, and then it's property management. What team members do you like, and how do you find good team members?
I think we have, I mean, same to you, property managers and the brokers are the most important team members.
Mm-hmm.
How do I find them? When it comes to brokers, it's a lot of legwork. So when I started
Mm-hmm.
investing, I started looking into Jacksonville, for instance. That was the first market that I picked. And I started by reading a lot and understanding where the better areas and the worst areas and looked at recent deals. And then I called brokers and I looked at the websites and I saw which brokers actually have the most inventory. I reached out to them and I said, hey, I'm an investor. I'm planning to buy in Jacksonville. It's a new market for me. Can we meet? And then I spent about a week there. What I did was basically meeting with property managers and with brokers And I walked properties, even properties I knew I didn't really want to buy because it was
Mm-hmm.
early on in my journey. I wanted to get FaceTime with them, and I got to know them. I went to see properties with them. Some of them drove me around and showed me the areas. So I know Jacksonville very, very well. And that was one of the 5 markets that I invest in. But you just have to do the legwork. You have to talk to different brokers, and then when you talk to them, ask them who is the best property manager, in the area. And when you hear the same name over and over again, okay, I need to meet with that company or person. And then I met with multiple property managers and went to see their properties, and then went to see, I went to see their properties as an official tour, and then an unofficial tour. I didn't tell them that I was going. I just went and I picked a random property because they obviously want to show you their best property. And I went
Mm-hmm.
to see a different property, and some of them, I didn't like what I saw because I just didn't, the property was not managed well. And that helped me zero in on the property management company that I wanted to work with.
Mm-hmm. I would also add, everybody, ask the property management companies who is the worst, or the real estate broker, who are the worst property management companies out
Mm.
there in your market, and you'll probably get the same one or two. So you steer clear from them. So that's something that we've told our students to do. Before we get to the short answer questions, can you give everybody a framework on how to actually get into the multifamily space? Because you've got it all. You've come from a foreign country. You got into the space. You got right into multifamily. You didn't put all your money into it. So can you give people a general idea? Hey, you know what? She can do it, but I can't do it. How can I start? Like, what's my next steps to take to get into the space?
I would say do one of two. Either start researching and get a mentor because it can really speed up the process for you and
Mm-hmm.
really help you, or or go to conferences, start educating yourself. And when you go to conferences, you're going to meet people that are either on the same kind of level that you are, just looking to get into multifamily, or people who have already taken that step and they're looking for a partner or they're looking to hire someone. And just going to conferences, doing those two things really expedited my process and my career. I
Mm-hmm.
have so many friends from those conferences, and I keep, some of them I don't go anymore because they're for, I used to go there when I was just beginning.
Mm-hmm.
Some of them I come back now as a speaker, and to some of them I still go because I go and I see people that I've met there years ago, and we've done deals together. And it will just expanding your network. You're going to hear about who are the better mentors, you know who is looking for a partner, who is looking to hire someone. You have to be out there and immerse yourself. You can't Nothing is going to happen if you're going to stay behind the computer and just read or listen to podcasts. That's being passive. It's a great first
Mm-hmm.
step, but it's not the full first step.
Mm-hmm. I like that, everybody. That's great advice. Number one is pay to play, seek to serve, get a mentor, or get out there and do something for somebody. And the second one is go to conferences. I love that because that was one of my biggest mistakes, not going to conferences, not getting face to face, just that networking. Let's take a quick time out to hear from our sponsors.
Gino and I are super excited to tell you about the audiobook version of The Honeybee, which was recently released.
The Honeybee tells the story of Noah, a disappointed, disaffected salesman who feels like his life is going nowhere until the day he has a chance encounter with a man named Tom Barnum, the beekeeper. In his charming, down-home way, Tom, the bee man, teaches Noah and his wife Emma how to grow their personal wealth using the lessons he learned from his beekeeping passion.
In the audio version, Gino and I sat down for an exclusive interview after each chapter where we elaborate on the stings we felt throughout the business, the importance of scaling up, and how we've been able to create multiple streams of revenue.
For more information and to get your copy of the audiobook, visit jakeandgino.com/honeybee. All righty, we're back. Jake loves to ask these short answer questions, so it's going to be my turn to answer them today. Ask him today. What's your best habit for success?
My best habit for success. That's a very good question. I think just not giving up. I'm
Mm-hmm.
a challenge junkie, and so I love challenges. There's nothing more rewarding than just overcoming the challenge, and not giving up is the one thing I think that separates winners from everyone else.
Mm-hmm. What's your biggest mistake when you started out in this journey?
My biggest mistake, where do I start? My biggest mistake was not getting a mentor earlier. I spent a little bit of time just spinning my wheels and trying to figure out how to do it. And if I had taken the mentor, a year or two before I actually started looking into it, I would have been in a different place. But it's okay. I'm not looking back. I don't like to do it, but probably I would have done it differently and hire someone a lot earlier in my career.
Jake has written down here, he likes to ask this. What's the best tip for someone getting started in multifamily?
The best tip is to immerse yourself in a different environment and get out of the house and go meet people, go to RIAs, go to local meetups, go to conferences and meet people that would change your life. And I've seen it over and over. I see people that went to conferences and started companies together. I personally partnered with people that I've met in conferences. It's definitely, it's a sports game and it's a team's game, and you can be part of the team if you're in your house and just read about real estate. It's not how it works.
On the show, Jake normally likes to ask, value add. You've said value add a couple of times. When you look at a deal that has value add, what do you consider to be value add? Because for us, it could be managing the property. It could be, adding revenue, raising rents. What are you guys focusing on when you're looking at deals to add value?
So the first thing that we're going to look at is the rents, and we're going to see, we're asking ourselves, is there a way to push rents either by renovating the units or improving the curb appeal of the property, or by just pushing rents even without doing anything significant because they're under market. And that's also a value add. So a lot of people think if the property is 100%, renovated, there's nothing much for me there. Yes, but if rents are even $50 below market and you can push those rents, and we've done it in other properties, then that's a value add. You're adding value, maybe not to tenants, but you're adding value to your bottom line, to the NOI. That's one thing. The second thing is we're looking at expenses. We know how much it's going to cost us to run the properties. And so if I see a property that, for instance, it costs, payroll is $1,800 per unit per unit per year in Atlanta, I know I can manage it for, $1,200, maybe $1,300. So I can save money right there. So we're also looking at the expenses. We go over every expense line and with our property managers, and we basically analyze how the property is being run today and how we can run it moving forward. And the third part of adding value is adding more amenities or more services that can help us increase rents or increase the income. So we're looking into, maybe we can add washers and dryers. Maybe we can do reserved parking and charge tenants $20 a month, or maybe we can build carports. There are all kinds of ideas of how you can create more income and increase it from X to, 1.7X or 2X. So that's, for me, that's value add.
So I like that, everybody. The number one is rents, looking at rents. Number two is the expenses on the property, making sure that expenses are in alignment with what you can do. And that's also, you have to create a budget for yourself and see what your budget is, what your pro forma budget is. And number three is the amenities. And amenities sometimes just is also tenant retention. Just because you're adding an amenity, you may not be able to get additional rent, but you may not be losing tenants. So you're saving on the property also and the services themselves. So those are three great value adds. What project are you excited about right now?
What project? We've recently actually, in my company, implemented OKRs, objective and key results, method. And that happened after I read the great book called Measure What Matters. And it really focuses, my team on what's our objectives and what key results are we trying to achieve. And that really helps us focus on what's really important in, because there's so many things to do. Work never ends, but that system focuses you on what's the biggest, goals for you and how to focus on those goals. And so that's one of my most exciting projects today.
So what are your goals? I mean, what do you, is it you do quarterly priorities, and quarterly ends up, or you bubble up to yearly? And I know people do 3 and 5 years, and you want to get your big, hairy, audacious goal and that, and we do that. So what are you focusing on as far as because people always ask me, how many units do you want to get this year? And they don't understand. It's just not number of units. It's the quality to me, at least the quality of those units. And I don't think people get that. So what do you like to form as far as the KPIs, as far as your key performance indicators?
That's a very good question. So definitely the number of units is part of it, but I'm also okay not meeting this goal, which is very rare for my personality to set a goal and be okay not meeting that goal. Because if my goal is to purchase 1,500 units. Now, this is the goal for 2020, but if the market is not there, if I can't find enough doors that are going to be worth it because the market is just not there and we get overbid, many times. So we're buying. For me, it's about buying right, not about buying fast. And I'm okay if I'm only going to hit 1,000, doors this year, but if it's going to be the right 1,000 doors, because the best deal that I've done is the deal that I never bought because I shouldn't have. And there are multiple of them. And so that's part of it. Another part, is I've launched my mentoring program a few months ago. So I have a certain number, there of how many people I want to reach, for instance. Another goal is to, there are all kinds of goals, but one of them is also when it comes to our branding. So the goals are kind of rounded. It's not only I want to buy X amount of units. It's definitely a big driver in our revenue, but there are other things.
I like that. So let me drill deep down a little bit with that for everybody, because also one of the key performance indicators is how many deals you're underwriting. If you want to get 1,500 units, I mean, if you underwrite 300 deals in a year and you don't get any, you didn't do anything wrong. Whether you hit the 1,000 units or you don't, that's not the problem. Fall in love with the process, not in love with the result, right? Fall in love with your actions, not your results. Because if Ellie's out there underwriting 300 deals and she's not hitting any of her buy criteria, it doesn't matter. She did her job because she didn't buy wrong. And that's right. No deal is better than a bad deal. That is so true. That's really important as far as focus on that, but then also focus on the actions that you're taking to get those deals. So then when it doesn't happen, you can look back and say, you know what, we have to underwrite 400 deals, or we have to go into different markets, or whatever that criteria may be. So that's really important. I like that advice a lot. How can the listeners get a hold of you?
So basically you can Google Ellie Perlman and you can see my website. The direct basically address is www.ellieperlman.com. You can also email me at ellie@ellieperlman.com. And Ellie is ELLIE.
Wow. So I wish Jake was here and let him recap this, but I guess I got to recap it by myself. So I think everyone's got to go back and really listen to this again, because there's a lot of different golden nuggets in so many different areas. First, about the capital raise, right? You have to really think about the money before the deal there, the power base, educating your students and educating your investors, thinking about the long game. Then Ellie discussed about, different markets, how to select the market with job growth and rents and cash flow and speculation. Then thinking of having skin in the game is really important. Then how to get into it as far as going to conferences or pay to play to seek a mentor. So there's so many different golden nuggets in this interview that I want everyone to stop, hit the rewind button. I'm showing how old I am, and really go back and listen to it, because it's important, because she skimmed over so many high level details here that if you want to get into multifamily, it doesn't matter where you're born. It doesn't matter if you're a man or a woman. It doesn't matter if you have money. What really matters is your desire and your ability to focus and ability to what you want to get out of life. At least I think. Any final words, Ellie?
Yeah, this is a pretty good recap. I would say that I really think that if you're focused, you can do it. If that's your focus, if you're willing to invest, your time and energy in it and not be distracted by other things, you can definitely do it. You got to have a plan. You got to go by the plan and not, be scattered and take random steps. But yeah, I think it's just, if you want it and you're willing to put the time and effort into it, you will do it. There's no question about it. You just need to do it right. be educated, make sure that you know what you're doing, because, you know, ruining your reputation is also very easy to do. So
Yes. I want to thank Ellie for being on the show, and for everyone for listening and from being part of the Jake and Gino community and sharing part of your day with us. Ellie, thanks a lot, and I hope you have a great day.
thank you so much, Gina. It was good. It was really, really fun. Thank you.
Thank you.